The main question when buying or selling a company is its valuation, or how much it's worth. So how do you arrive at the correct value? Well, the answer is it all depends. There is an old saying, a business is worth as much as someone is prepared to pay for it. Investors want to consider if they're getting a good value for the business they're buying. So, will it bring them profits in the future are the questions that they're going to ask, and how long will it take for them to recover their investment? Investors will want to pay as little as possible. Sellers, on the other hand, will naturally want to achieve the highest possible price for their business. In most cases, they have built their business from scratch and it's their baby. It means a lot to them and they value it more than anyone else. It is important that the sellers are aware of the factors any investor will look at when buying their business and be prepared for these in advance. The challenge, though, is to get the right balance between the buyers and also the seller's expectations and to complete the transaction. Now we come back to the same question, which is how to get the right valuation. There are several methods that can be used when valuing a business. The first method is called asset-based valuation. In this method, we look at the company's assets. You can try a bottom-up approach, for example, when buying a property, and this includes buying land and building costs. Look at values of other properties in the area, and the buyer could look at the future income value from the rentals or the capital increase. You will need to take a look at the time it will take to build your business from scratch to a level where it's operating smoothly and generating an acceptable level of profits. Look at values of other properties in the area. The buyer could look at the future income value from the rentals or the capital increase. You will need to take a look at the time it will take to build your business from scratch to a level where it's operating smoothly and generating an acceptable level of profits. It could be, for instance, much cheaper to set up a business from scratch, but that could take, say, 10 years to become stable and hence also profitable. Will the buyers be prepared to wait that long is definitely the question, and the answer is probably not. Instead, they will want to pay a premium and buy an already established business and start the benefits immediately. An alternative approach would be to get a fair market valuation of the target company's assets to arrive at a valuation. The second method is to look at the price to earnings ratio, or a multiple of the EBITDA, earnings before interest and tax. This is essentially the relationship of the price and the company's earnings for the year. This could be, for example, a multiple of 10 times the EBITDA. If you have been running a business for a number of years, you should know what your company's EBITDA is, or you can speak to your accountant and find out. The multiple used can be varied from the sector to sector, and it will very much be dependent on the future profitability and also your income. You will need to consider factors such as scope for growing the business and enhancing the EBITDA. You can also consider merging operations with an existing business and achieve economies of scale to reduce your costs and therefore increase the profits. The third method is to look at the discounted cash flow. This method looks at the projected cash flows in the future from the business. We would look at, say, 5 to 8 years in the future and then discount those cash flows to get an idea of what they're worth today. This method is generally quite difficult as you're looking into the future and will have to rely on a number of assumptions. We start by looking at cash flow for the last 3 to 5 years and then check the factors that could affect the cash flow, such as change in the market, the contracts, legislation, and the drive of future cash flow. We will also be looking at the future sale of value of the business if we were to sell it. So if you were to buy a business for X and some years later sell it for 5 times X, then this business will have a much higher value for its buyer. The fourth method is turnover-based valuation. This is also an important method as some buyers may be only interested in a business's ability to generate income, and they will value that business as a multiple of its annual turnover. This is where the buyer can buy recurring fees and contracts or stream of income and can manage their costs. Each of the 4 options we have discussed will come to a different valuation, and ultimately, an informed buyer will look at almost all of these 4 methods and then arrive at some kind of future that makes the most sense for them. Again, any investor will be very keen on first checking how long it will take for them to recover their investment, and then how much profits will they generate in the future years from that specific business. If you're looking to value a business and need our guidance, please get in touch with us through our contact form, and our expert deal negotiators and valuers will be more than happy to help.